It's great to be here with Dan. Dan's a great guy. Investing, what a great place to be here. So I was happy to go ahead and do this despite kind of a crazy, hectic schedule I got going on right now. So with that being said, what we're going to do is we're going to talk about a strategy that's near and dear to my heart, and we're going to talk about it in a level of detail that I haven't really shared for quite a while here, actually. So this will be good for you guys to do this deep dive with me since we have a little extra time. Just a little bit of a reminder here: trade involves risk, not just reward. It's great, talk about how much money we can make, but remember, trade involves a lot of risk as well. Make sure you have a risk trading plan and consult a registered financial representative forever doing any trades. Also, if we talk about hypotheticals here, if you guys ask me, well, how would you trade this if the sky were a little bit gray, the temperature was always 65 degrees, and how would you trade that way in 2 weeks from now? Well, that's kind of a hypothetical. And so so I try to keep it real, try to keep it focused on trades we've actually done, or structures in the way we actually trade and so on and so forth. But if you ask hypothetical, it is, of course, a different kind of result. That's why I like to trade real with real money in my trading room, and of course these competitions around the world that Dan alluded to. So also your options involve risk, not just reward as well. And there's a great website you can go to learn some of the special characteristics about some of the various risk profiles for those. All right, well, with all that being said, so I appreciate you guys being here this afternoon and evening for many of you around the world as well. I've been blessed to win a couple trading competitions earlier this summer as well, and we're going to, and actually some of the strategies I used during those, we're going to actually talk about during today's event. So it's a good time to go ahead and be here with Dan and his crew. So if you trade stocks, options, futures, or Forex, then you're in the right place today. If you're a long-term investor only, this presentation won't be specifically geared to you, but day and swing traders in stocks, options, futures, and Forex, that's who this is geared towards. Now, I don't know how many of you out there know me, but I used to get these when people would see me. They'd walk up to me at the shows and be like, "Well, why should I listen to you? Who are you?" I've literally had people say that to me. Walk up, like, "Who are you? Why should I listen to you?" It's like, well, you know what? I used to be put off by that question, but really, it's really a great question. After I've seen it in the years, so many people talking about trading, not actually doing it. So let's just cover that briefly. As Dan mentioned, I am a 25-time domestic and international trading champion. I get featured in different institutional groups like the CME here. Actually just did some of those, for the CME, just did an event here recently for a big product launch for them. Been featured in a lot of domestic and international trading magazines around the world in various languages. That's my ugly mug that you're seeing up on the screen there. I was taken a couple months ago in the lower right-hand corner in Spain, where I was doing a speaking engagement there in an interview. So, talked about a lot of these different things. This is the real reason why you guys are here with me today, is because of these trading competition wins. So you're talking to somebody today who's been there, done it, bought the postcard, had the huge losses, had the huge wins, and then put it out there against some of the top competitors that were chosen to be there in these big events around the world. So some of those events could be obviously pretty big. The ones here in blue are international. The ones in black are domestic competitions. So, these big international ones, of course, can be, along the lines of this, where you got a whole bunch of us herded like cattle, usually around 16 of us, down to 8, down to 4, down to 2 for the final battles over the course of like 12 hours. So these are different years of the show. Some of the shows and some of the international competitions. So then it's highly regulated. You get a whole bunch of judges standing all over you, confirm, because you got to confirm each trade live. It's kind of crazy. And then here in the United States here, there's some of these big auditorium-based, competitions as well, where several of you have come to see us do these live competitions and that as well. So a lot of fun, and love putting it out there live. I was the first American to ever win the international trading competition over in Paris, France. That was pretty cool. And then went back in 2013 and did it again. And then 2014 did it again. So these are real profits, about $4,837 in 18 trades over 6 hours. We're going to be talking about some of those strategies I used in some of these competitions in just a few moments. So in summary, when I say, who the heck are you, why should I listen? I actually trade. I don't just talk about trading, I actually trade. There's a big difference in that. But I like to remind people that regardless of, what an old fart I am these days, the reality is that I started, just like most of you, reading books. This is actually the first books from the library that I had when I was young, as a teenager. How to read the Wall Street Journal. How to read the Wall Street Journal, gang. I'm not kidding. These are the actual books I had from the library. They're still part of my collection to this day. And so that's where I started. So I understand the journey that many of you are on today. I also had basically three jobs, 2 full-time and a 1 part-time job. And I was raising a son at home who fortunately became a United States Marine, a very productive member of our society. So with that being said, yeah, exactly. So I got some gray hairs to show all that. And so what we have here is this competition, this strategy I'm going to talk about today, the inventory retracement bar strategy, actually used a few months ago. You can see several of these inventory retracement bars. We're going to talk about what these are and how you can identify them on your computer while we're working with each other today. Hopefully all of you have access to charts to kind of start looking for these things while we're actually talking today. Let's do a little learn while the markets are open. So a couple things that are special about this strategy. It can be used to get in, stay out, or get out of trades. Okay, so it's a very versatile trading strategy. I've written about it in these international magazines. It's been featured in several languages around the world, and so it's really near and dear to my heart. It acts as a key support or resistance level until broken for targets and continuation trades. Let me just kind of show you some examples of trades, loss avoidances, taking small losses, how I used it in different ways here. So here's an example. So I'm going to get into the actual structure of the whole trade in a few minutes. I just want to kind of prep you for the examples. So here's an example. We have several of these inventory retracement bars. Well, that acts as a key support level. So in fact, we had actually 4 of these back to back on this 15-minute chart. Well, so as it's coming back down here, I was sitting there thinking about trading because my short-term signals on my 2-minute chart was saying sell. But when I saw all this support in the backdrop, I said, you know what, I can't take that trade on this 2-minute chart. The 15-minute chart and the 5-minute chart have a ton of support down here. Well, so that kept me from taking a trade. Well, look what happened right afterwards. Okay, so this is really important to this process. You'll see that it stopped there in all those inventory retracement bars, turned right around. Because let's talk about what an inventory retracement bar is. It's where one or more institutions that's not only stopped the market from going down. It's not only stopped the market from going down, but it's actually driven the market back up. That takes a lot of money to do. Does that make sense? So when we see one or more institutions have a bunch of inventory in that area, we want to take notice. Does that make sense to everybody? And so armed with that information, these are why we want to identify them. They are key support until broken to the downside. They're key resistance until broken to the upside. Okay? Yeah, there's moving averages in here and all sorts of other gobbledygook. I don't want you to worry about that, AJ. I'm going to show you exactly what I want you to worry about. We're going to keep it real simple for you and have you focus on just a couple simple things today, all right? Because I want you guys to be able to take away some important information here. So as we take a look, here was an example of this I was in a bond trade here, and so the market was going down, pushed back up, then we had an inventory retracement bar. So this caused me to continue to stay in a trade because we generated a fresh sell signal to the downside. And that was important because that helped me gross about $1,250 on that bond trade. All right. So now we've talked already just in 2 examples of where I kept out of an actual trade, where it kept me in an actual trade. Now here's an example of how it went ahead and got me out of a trade. So here I was trading the DAX. Okay, and we were in the trading room. I was trading the DAX. Well, all of a sudden, one of these inventory retracement bars of the distribution kind, which you're going to learn about in a few moments, went ahead and actually stopped me from wanting to proceed with any further trading. So when I saw this, I locked in my profits. So it helped me get out of a trade because this told me, in addition to long-term resistance coming down, with the distribution bar locking in, one or more institutions went ahead and voted with their money to start selling this. Okay, that's a big deal. So With that being said, now we're seeing how it helps get out of a trade. All right, well, here's an example as well of getting into one. So here's another one of these bars, which we're going to teach you all about in a few moments. Bars are 45% or more off their low in a downtrend. And once we look to get short, 1 tick, 1 cent, 1 pip below the low of those bars, then we're looking for whooshes and continuations to the downside, okay? So these are, more trades that we focus on in the trading room. Now, here it helped me get out with a small loss, okay? So here what happened, remember what I told you, we start seeing those accumulation bars, and what happened was I went ahead and was focusing on shorting, but then these accumulation bars came in, and it's like, whoa, wait a minute. So I was in a bond trade here, and that resulted in a 3-tick loss, because once I saw accumulation coming in, I didn't want to be anywhere near that trade anymore. Does that make sense? So when I'm looking to sell and I see buys, accumulation buy signals coming in, I want to get out of that trade, okay? And so that is really, really important information, because look what happened. Look what happened afterwards. This market went ahead and turned around, went to the upside. We had positive divergence locking in, and this market took off to the upside. So it was the right decision to identify those accumulation bars and get the heck out? Absolutely. Okay, so really important here. The only things you're going to have to worry about today, Kisraj, are going to be this black line. That's a 20-period exponential moving average, and then the price bars themselves. That's the only thing you're going to have to worry about. Now, what happened was, so I showed you how we had like small losses. I showed you how we went ahead and stayed in larger gains because of this. Then we turned around after that small loss, got right back in here. What ended up happening in the S&P into the afternoon, we had one of these distribution bars. Well, once a distribution bar is broken above to the upside here, then that's a great continuation trade. That results in about a $625 gross profit afterwards. So the key is keep the stop losses tight and trying to let the winners run for bigger profits, okay? That's the theme here, and so with that being said, let's go ahead and get into the rules of the actual trade, and then we can show more examples, all right? So what is this? It's a price action based trend continuation trade. That's important. The probabilities go down dramatically when you're using this as a sideways market indicator. Okay, I've got a great story out of California about that. So we'll talk more about that in a few minutes. So price action continuation trade. When do we use it? It's most effective in trendy markets. How do we identify the trade? Looking back over the last 20 periods, notice I say 20 periods, because I look at all sorts of different charts to execute trades off of, whether it's a 2-minute, 5-minute, 15-minute, hourly. Those are the intraday ones, 2, 5, 15, hourly. If for this particular strategy, I want to use 2-minute or higher charts. I don't use 1-minute or tick charts for this particular strategy. 2-minute charts or higher, okay? But beyond that, then whatever my favorite time frame is, well, I like to trade if I want to trade a 6-minute chart, a 12-minute chart, that's okay, as long as it's 2 minutes or higher for this particular strategy. So looking back over the last 20 periods on the time frame that I'm looking to trade, I'm looking for these things called signal bars, where the open and the close are approximately 45% or more off their high in an uptrend, or 45% or more off their low in a downtrend. Now, this is real important, gang, because if you're a daily or weekly chart trader, these work just as well, in my opinion, if not better, on those charts. This concept was originally born out of my longer-term equity trading focus in the late 90s. So it's important to understand that if you like trading stocks, like trading options, this is a really great strategy as well. And perhaps you could tie it with like my friend Larry's stuff that you learned earlier. So ask yourself how much wick is showing. Is it approximately 45% or more? All right. Now let's go ahead and take a look at these. So here's what we're looking for. we have a downtrend in place. When we have a downtrend in place, what I'm looking for, I'm looking at the low of the bar and the high of the bar. Now, basically what I want is I want the tail to be in the bottom 45%. So we just take the high to the low here and draw an imaginary line right through around the 50% mark. Okay, then what we're asking ourselves is that tail in the bottom 45% or more off the low in the downtrend? And you can see with each one of these examples, now this one is grossly exaggerated because here's the high, here's the low. It's about 95% off the low in a downtrend, right? And these are 4 individual unique examples. And the reason why I have that for you is because people often say, does it matter if it's a big red bar, a small red bar, a big green bar, or a small green bar? And the answer is no, it does not matter, okay? What matters is that we're in a downtrend over the last 20 bars on a 20-period exponential moving average. Now listen, if your favorite moving average is a 19.26195, that's the secret one, or a 21-period moving average, it's okay. Somewhere between 19 and 21 periods, I use personally in my trading a 20-period exponential moving average. So I'm looking over the last 20 bars and ask myself, are we basically in a downtrend? Okay. Now, from there, again, I want to look and ask myself, is the open and the close approximately 45% or more off the low? And you can see with each of these examples, the answer is yes. All right. Now, in an uptrend, I'm looking for just the opposite. I'm looking for bars that are 45% or more wick on the high side. Okay, in an uptrend, so basically in a downtrend, I'm looking for big buying to come in and not only stop the market from going down, but I want to see where one or more institutions is actually driving this back up. That's what's important here. Okay, in a downtrend, I want to see where one or more institutions is actually selling it and driving it back down. Okay, now that's important because then we'll show you the entry side of this in just a moment, but that's what we're looking for structurally. These are called signal bars. All right, so where's the entry? It's typically 1 tick, 1 cent, 1 pip above or below that signal bar. So remember, in a downtrend, I want to see bars where the market is going off the low, coming back up, off the low, coming back up. Now, what I want to see is the market roll back over, break 1 tick, 1 cent, 1 pip below that low, and that's where I want to short. Okay, so in a downtrend, I want to see where that inventory, I want to see basically, remember, we're in a trend here. So I'm looking for a trend continuation trade. So what I'm looking for is where one or more institutions has not only gone ahead and stopped the market from going down, but has actually driven it back up. Okay, and yes, I find it's easiest to identify this, Kisraj, with a Japanese candlestick. For me, my eyes just always draw towards candlesticks for easy identification of a red body or a green body. I don't use that for the purpose of an actual execution. I really don't do much in the way of Japanese candlestick executions. There's a lot of great books out there kind of outlining the percentage of success and or failures as it may be in there. So do your research on those before you do that. But what I do is I use candlesticks simply for quick identification of trading opportunities. Now, so what I'm looking for here in an uptrend, I'm looking for that one or more institutions has stopped the market in its tracks and is actually driving it back down. Now, in this case, when that starts happening, anybody who's thinking about taking a trade all of a sudden backs off. They're like, whoa, good thing I didn't take a trade. That would have been another one of those losers. Well, then all of a sudden they turn around, they come back a little while later, and now the thing's up, and it's up well beyond where it was. And that's what we're looking for. We're looking for that short-term pause in the market that then we get a resumption on the back end of it. That's what we're looking for. Okay. So with that being said, let's go ahead and we move on here. And I'll try to answer some more questions as we go along. One tick below the close of below the low. So it's one tick below the low. Good question, George. It's one tick, one pip. So it's not one tick below the close. It's one tick, 1 cent, 1 pip below the low in the downtrend. And one tick, 1 cent, 1 pip above the high in the uptrend is the entry. So it's an intra-bar technique. You're not waiting for the close. All right. Let's go ahead and this actually happened this morning. You can take a look. If you look at the NASDAQ 5-minute chart, you can see we're in the uptrend here. We came 50% or more off the low in the downtrend, and then you'll see this whoosh. We'll talk about that whoosh and its significance in just a little bit. Okay. Let's talk about where we exit the trades. All right. Now, and by the way, you guys are asking some great questions, and I'll get back to some of those. Some of these will be answered, as you can imagine, as we're going along. Just want to make sure we have enough time for everything. So as we take a look then, with the exit, it's a trailing stop to the next key support resistance level. The trailing stop is a big factor for me. And so let me talk to you about my strategy on that. It's the 50, 80, 90 price strategy. So with trailing the trade, we want to identify a couple of key things to remember. We want to identify our target before we enter the trade, because we never get smarter once we're in the trade. My favorites are the classic daily, weekly, monthly floor trader pivots and long-term support resistance levels like the 50 or the 200-day moving average. This is really important. Classic floor trader pivot formula. There's a lot of people out there. Everybody's taking the classic formula, modifying it a little bit, slapping their name on it, and selling it for a bunch of money. The stuff that I find works the best, being completely honest about it here, is you going ahead and using the classic floor trader pivot. So they're either called pivot points, floor trader pivots, something like that. If you're seeing it with a name on it, so if you're seeing Rob Hoffman pivots, those aren't the right ones. The classic pivot is what you're looking for. All right. So we want to then I want you, when we're 50% of the way to the target, we want to start trailing by 50% of overall profit earned, which means if it actually comes back and hits it, that basically means it's locking in about 25% of the overall move to the target. When we get about 80% of the way to the target, we start moving about 80% of profit earned, trailing it by 80% of profit earned. So you notice we're getting more aggressive as we're getting closer to the target. When to the target, we trail up to about 90% of a profit earned. This is giving you a chance to run, but if it doesn't, then we're going to lock in the profit. If the target is broken through, then we just trail right behind the price until it stops us out with our profit. If the price stalls at the target, we just move it up to the current bid or offer. So I'm going to show all this to you graphically in a moment. I just wanted you to kind of get the rules. But gang, I'm going to tell you right now, this was one of the biggest things I learned in my career as a trader. My biggest loss in my trading career was actually a profit that I didn't trail. Okay. Now, how many of you in this room today have had a perfectly good, trade but you wanted more money out of it, and so instead of trailing your profit, you're like, just a little bit more, come on, just a little bit more, and then it turns around, stops, goes against you, and takes away your profit and actually turns into a loss. Okay, so you understand exactly what we're saying there then. So with that being said, armed with that information, we don't want to go ahead and repeat that mistake, right? And so where we're at with this is that I want you to understand this was a big deal for me. When I started doing this, that's when I went on to win all those trading competitions. So something that hopefully will hit home with you. It set me off the path, the competitions, and new accomplishments in my trading room as well. So the golden rule, trail the stop so you don't have to have things like news releases, take your winning trade and turn it into a loss, which is what happened to me years ago. So with that being said, let's look at this graphically. So here's how this works, all right? And let me actually pull that up their way. Now, So here's an example. This was a live trade that was done. This was a concept I just taught to students in a live event, and then the student went ahead and recorded actually doing it. So it's a student taking the trade using the strategy. So here was the target identified out into space. All right. The trade was actually taken here. This happened to be a Japanese yen trade. It doesn't matter. It could have been widgets. It's all the same. Okay, so what ended up happening here is that as we got about 50% of the way to the target, so that's about up here, okay, then, and so here's the current price, what happens is the trailing stop gets moved up about 50% of the way. So what this means is, in effect, if this turnaround stopped and went back down, then basically you're locking in about 25% of the overall profit earned for the overall target, okay? Now, as we get 80% of the way to the target, now we're starting to trail by 80% of the profit. Why? What's more likely to happen after you've been going up, up, up the ladder and you're getting closer to resistance? What's more likely to happen, gang? Is it more likely to just keep going, 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 or is it more likely to potentially stop and fail as we get closer to that resistance level? Absolutely. It's far more likely to stop and reverse, right? So what makes more sense? There are some very expensive schools out there that teach you just put your stop back behind here, have your target out there, and set it and forget it. Some very expensive schools, and that can cause you a lot of problems. And so, like I said, what happened from my perspective, giving something a chance to run to a target, but then trailing the stop is what I found was a huge change in my trading behavior and a key to my success here. So with that being said, here then as we get to the target, start trailing up by 90% of profit earned. Then if it doesn't break through that, because 1 out of 10, 1 out of 12 times you'll get a big spike through here, all of a sudden a boom, 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 and then it'll trap in the retail traders and then fade out. So if it doesn't do that, then just trail it up to right current bid or offer and wait to be taken out. If it does go ahead and go boom, 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 then basically 1 for 1 as it's going up, I'm just raising the bid right behind it, expecting that it's going to stop and then it's going to roll back over. Okay, so I want you to all think 50, 80, 90 price, all right? So stop loss. The stop loss is going to be 1 tick, 1 cent, 1 pip below the low or the high of the signal bar on the opposite side, or a predetermined loss value. Plus, I'll show you a little secret for the back testers too. So remember where our entry is. This is a downtrend. Who can remind me, where's the entry here today, gang? We're looking to go ahead and take this trade. Am I looking to short or am I looking to go long? We'll see who's grabbing this the best and the fastest. Okay, we're looking to go short, right? Short 1 pip below the low. Exactly, George. Nicely done. So looking to go short 1 tick below the low, right? All right, so at the same time, then on the upside, we're looking to go short 1 tick above the high, right? All right, well, the stop loss officially is 1 tick beyond the opposite side of the bar. So if you're going long up here at the top, 1 tick, 1 cent, 1 pip above the high, the short is 1 tick, 1 cent, 1 pip beyond the opposite side of the bar. Now, 2 little notes to you. First of all, if that distance, let's say this is a weekly chart. Well, if this is a weekly chart of an $800, $900 stock, the low to the high could be a $20, $30 or more spread. So if that's the case, you may not want to sit there and take a long up here with a stop loss, $30 away. So that's where the predetermined stop loss value comes into play. You may say, look, I'm only willing to risk $5, $10 on this trade, or I'm out, okay? That's why I said predetermined loss value. Officially, and by the way, don't forget, you could always, if the heat is too much for you on a trade, you can always elect to just skip the trade, right? Not being in a position is sometimes the best position, okay? But that being said, let me share with you a little secret too, all right? if statistically speaking, especially in high beta stocks, so in high volatility type stocks, what happens is if it even goes back more than 60%, beyond here, you're more likely to actually get all the way back down to here. Okay, so if it goes back more than 60%, it's more likely to actually go all the way. So in other words, and you have to take a look at this on the instruments you trade, all right, because everybody's instruments are going to be a little bit different. But if you notice that after the 60% that it often goes to the 100%, then from my perspective, a little secret is you can actually consider exiting the trade right there at the 60% mark, saving yourself 40% extra unnecessary loss. Okay, so keep that in mind. That's a little extra secret there that I wanted to share with you guys, because what should happen when we get beyond this level, we're expecting this to start whooshing to the upside, or if it goes down one tick below, we're expecting this to whoosh to the downside. In fact, actually, like I said, we looked at this earlier. Notice the same exact thing right here this morning. Can you guys see it? The market's going up. There's your distribution bar, 1 tick, 1 cent, 1 pip. Look what it did afterwards. Whoosh to the upside, roughly 8 points, 32 ticks on the NASDAQ. Okay, so but notice that it whooshed there right thereafter. So that's the kind of thing that we're talking about. Okay, so those were a couple of things I wanted to show you there. Now, a couple key points I want you to remember. Think about the concept of rocket fuel. If it's moved a large range quickly, then the breakout is more likely to at least temporarily fail. So that's why you want to watch out for bars like this right here. I usually like to see the 40, 50% type bars, maybe even 60% wick bars. But when you've got a bar that's like 90, 95% wick like this, let me ask you a question. We're supposed to short down below, right? Well, think about this now from an energy perspective. I'm looking to short down here, but wait a minute. The market's way up here. That means it's got to come all the way back down here just to get into the trade. Now, where's all the energy and the continuation going to come through just to, continue on? You following me? Okay, so let's go ahead and a couple other things. Diverse applications, whether you trade like trade stocks, futures, options, Forex, this has very diverse applications on different time frames. Okay, different time frames here. So a couple other things you want to remember: trail your entries to reduce the risk of reversion to the mean. All right. Key points to remember: trade in the direction of the BBT Pro Trader Pack or a very basic alternative, the 45-degree angle 20-period exponential moving average. And for the purpose of today, I want you guys just to disregard this part right here, okay? But the 20-period exponential moving average certainly is very important to us here, okay? Now, so with that being said, 20-period exponential moving average, that's what we like to see. Like to see the last 20 bars of data and a nice downtrend in place. That's the kind of thing I like to see. What I don't really want to see is a flat 20-period exponential moving average. I'm going to show you more about that in a little bit. All right, so here's all the rules together. I'm going to pause this for a minute. I'm not sure. Dan very likely might be sending this out, but I don't want to overcommit him in case he's not sending out replays later. So here's a copy of all the different rules together. All right. Now, so in summary, we're looking for a downtrend. We're looking for bars to be 45% or more off the low in a downtrend. And then we're looking to go short 1 tick, 1 cent, 1 pip below the low of the bar. And just remember, these are 4 individual examples, not a pattern. Okay. So then we go ahead and look up above here. We have the 1 tick, 1 cent, 1 pip above the high is the entry. Stop loss is 1 tick, 1 cent, 1 pip below the low officially, plus I showed you the little secret. So let's go through a marathon run of some examples here so you guys can become little experts in this. So here's a weekly chart, a daily chart of Apple here, and I like to show this one because this was one I showed publicly years ago, and I still to this day use it as a case example for institutional clients. So it's one of the ones I show publicly, and so we'll just go ahead and we'll talk through this. These happen all the time. Hopefully, what you guys are starting to do behind the scenes is already maybe going and looking at a couple of your charts. Just take a 20-period exponential moving average and take your favorite instruments and start seeing if you could spot some of these on your charts. All right. So here's a weekly chart. Now, this is a bar that's 45% or more off the low in a downtrend. So what are we looking for? We're looking for it to break 1 tick, 1 cent, 1 pip below the low. I want you to notice two things here. Once we had that accumulation bar, it not only stopped the market from going down, but actually drove it back up, which gave it a great short opportunity, which we're not going to be able to talk about today, one of my stochastic spike strategies. But what happened was, notice that when it came back down, it stopped for 2 weeks at that level. For 2 weeks, it stopped at that level because one or more institutions had so much information, so much inventory that they wanted to buy at that time. It went ahead and held the market there for 2 weeks. But once that inventory left, look what it did. It dropped about $30 the rest of that week. Okay. Now this brings to light a couple of reasons. Number one, the reason why we trail our trades is because if you don't, you could turn a perfectly great profit into a loss. Because remember, 1 tick, 1 pip, 1 cent above the high of that bar is your stop loss. If you didn't trail this down the $30 to the round number support over here, then what ended up happening was you held on to it because you wanted some extra and weren't trailing. It turns into a loss. Okay. You don't want to see that happen. So that's why we like to trail it. Now, then what happened over here, the question is, can you get into another trade if you see another signal bar? The answer is yes, as long as you still have a trend. Okay, so once it breaks 1 tick, 1 cent, 1 pip below low, what you're expecting, kind of like over here, you're expecting because the market's in a downtrend for it to whoosh to the downside. Same thing over here, it whooshed to the downside over the next several weeks. All right. Here's a daily chart of that same time frame as this was happening over here. So notice what happened. We were in a downtrend. We had an accumulation bar. It sat there for 3 days. Sat there for 3 days, gang. What happened after it broke down below? Whoosh to the downside, didn't it? Sat there for 3 days. All that inventory was built up there, and then it broke down. All right. Well, so then the question is, can you get into another trade? And the answer is yes, as long as you have a downtrend, right? Make sense? Okay. Now, what about up over here, though? This is another accumulation bar, isn't it? And so once I get 1 tick, 1 cent, 1 pip below the low, I should be looking for a trade. Or is there something that's wrong with this particular one that should keep me maybe from taking the trade? It went ahead and was traded. That's right. Look at that. It got back above that 20-period exponential moving average. Do not want to be taking fresh shorts above that 20-period exponential moving average. Very good. Very good. All right. Guys, doing great. So let's take a look at some actual competition-winning trades that I did here in the past, and then maybe this will make sense for you. So now, we had a downtrend coming into place. We had 45% or more off the low. I went ahead and went short here. Was that the right thing to do? Sure was. Over the next few minutes, whooshed to the downside. That's exactly what we expected to do. Here was another one here. Now, this was interesting. These were 2-minute bars. And so you saw those pictures of the competitions, how I'd have referees, judges standing over me because you got to notify them of your trades. They got to verify them. They're in your live real account because I'm a real live trader. So I have no problem with showing live trades. So I had to call the judges over and say, hey, look, I'm looking to do a trade. Well, so what I did was this. We had a downtrend in place. 45% or more off the low. Great. I was able to put the order out way in advance because I saw the bar. I was able to put the order out in advance, and so the market came back up, and about 18 minutes later, broke down below. Once it broke down below that accumulation bar, what did it do, gang? It whooshed, didn't it? Okay. Now, so then I took my profit, and in this case, then we had another bar lock in, and so I went short down below again, and it pushed down again. Okay. 2 minutes. 2 minutes is the lowest I would recommend doing it, Larry. Do not go ahead and look for this on 1 minute charts or lower. Too noisy. Too noisy. Okay. So, but then as far as on the high end, weekly charts, your daily charts that are perfectly fine with this. Just anything two minutes or above. Okay, so then another example here, the market was in a downtrend. You can see this bar was 45% or more off the low. I went ahead and went short right below the low. What did it do? It whooshed to the downside. Okay, so this is important for you guys to see and understand. Now, does this look familiar? Now as I'm starting to bring you back to this example, so we're looking for a downtrend. We're looking for bars that are 45% or more off the low. 45% off the low. And as long as I keep getting those signals, I can look for reentries. Now, a lot of people ask me, well, what about just adding into your current trade? All right, here's the thing. I'm going to tell you right now, the trend is your friend till the bend in the end, right? An old adage that's so true. The further, the longer a trend goes, the closer you are to the reversal than you are towards the beginning. Does that make sense, everybody? And so with that being said, what we're looking to do is I don't want to keep adding to a new position, get real heavy towards the bottom right before a big reversal. All right, I'd rather take each individual trade, whatever size I'm comfortable with, right up front, rather than building the position bigger and bigger and bring my cost basis down closer and closer here right before a big reversal. Does that make sense? It sounds real good in a textbook, but it doesn't work out so hot in the real world. Does everybody understand that? Little aha, important tip that you guys should remember, please. So let's look at some more examples here. All right, so here you have an uptrend. This was Apple after it split. Same great stock. This is a daily chart, though. Now, let me ask you a question. Can everybody see these? One tick above, one tick above, one tick above, one tick above. All those, so in this case, 1 cent above each of these different areas was a fresh reentry opportunity. Now, if you're an options trader, what are some things that you can do if you see this strategy take place? Can you do anything with options with this, or are you just, is it useless? You can certainly buy calls or you can sell puts, right? If you want to keep it real simple. You can make it as complicated as you want, okay? But, it doesn't have to be, all right? You find a directional trade. So this is not an iron condor strategy. This is not an iron condor strategy. This is a directional play. And you're identifying the direction, which makes it a lot higher probability when buying, calls, selling puts, something like that. Just make sure you understand your risk profiles when you're selling something, versus buying something. Very important. So so let's look at some more examples. So here I'd actually taught this strategy over in Barcelona, Spain, and then turned right around and we got into the markets and the strategy is fired off. Here is my 20-period exponential moving average. There you can see the inventory retracement bar. What happened when it broke down below? What did it do? It whooshed, didn't it? That's the expectation. See, what's happening here is the market's going down. All of a sudden, it starts going back up. Anybody who is thinking about shorting, first of all, a lot of traders, what they do is they wait till they get the big red bars before they finally short. So then the market takes them out. Well, then the people who didn't get in, who are thinking about getting in, see, whoa, good thing I didn't get into a trade. That would have been another one of those losers. Then it turns right around and goes right back their way, and it goes without them. Like, I knew it was going to go down. Well, so this is all designed to help work around that. Okay, a couple things to keep in mind. Trade with a reasonable trend. The more shallow you make the trade, in the trend, the lower the probabilities of success with this trade or any other trend. And the story from California kind of explains it all. So I'd gone out to California years back, and I was teaching this strategy. And then I got a follow-up from a student who went ahead and was telling me, "Hey, Rob, what happened to that strategy of yours? It's not working anymore." And I'm like, what do you mean it's not working? I just won more trading competitions with it. I've been winning competitions with this now for several years. And so I'm like, I'm still using it. I use it in my trading room live in front of people. What do you mean it's not working? Well, so come to find out, what he did was, instead of looking for that 45-degree angle, he realized that he could still get trades, and he'd get a lot more trades. You guys see where this is going? The more shallow he made the trade, the trend. Okay, so what do you think happened though? This is all predicated on the fact that you're going to break back down into the direction of the trend. Well, the less of the trend you have, the more likely it's just going to revert back to the mean and stop you out. So what happened was, I'm looking at this and I'm like, well, no wonder you're losing money. You got virtually no trend. He's like, but I got a lot more trades. I'm like, now you got a lot more stop outs. You see the correlation, gang? So, in this way, with a 40, 45-degree angle, you're going to have less trades, but you're going to have a higher probability. But yes, you will get a lot more trades if you shallow out the angle, but then you're going to have increased losses. Does that make sense? So here's a great example of this. So right here, you see this 20-period exponential moving average is dead sideways. Well, in this particular case, and this is the kind of thing he'd see, is, well, here's an inventory retracement bar. It broke below. It went lower. Then there's another one. It broke lower. There's another one. It broke lower. Here in this example, you got like 5 or 6 inventory retracement bars back to back. Every time it breaks it, it's going lower and lower. So he saw, well, hey, you know what? The more shallow I make this, the more trades I get. But then his losses went up, and so it didn't work the same way. And so he was like thinking it didn't work, but actually all he did was he twisted my work, and that's not good. So keep in mind, we want that trend in place. The better the trend, the more likely the whoosh back into the direction. Does that make sense? I just want to make sure everybody's completely understanding that. I want to make sure nobody here, thanks, Bill, good. I want to make sure nobody here comes back to me down the road as like, Rob, that's not working. All right, point number 2. 2 or more IRBs back-to-back or within 2 bars of each other can spell trouble for your trend continuation. Consider tightening your trailing stop. All right, so here's what happens. I want you to see this. Notice that we're in a downtrend here. You guys see two of these within 2 bars of each other? Indicated a trend. Oh, up here, now you had 2 or more of them back-to-back, indicated directional change. All right, now here the market was going up. Now you have the bars within 2 bars of each other, 2 distribution bars. It went back down. All right, now you got 2 accumulation bars back-to-back with each other. It indicated the trend again. You following me? So 2 or more accumulation or distribution bars within 2 bars or less of each other usually spells trouble for the continuation. Okay. Point number 3. An IRB appearing on multiple time frames at the same time dramatically increases the likelihood of market reversal. Okay. So here's an example. This was a 2-minute chart, a 5-minute chart, a 15-minute chart, all firing off distribution, 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 all at the same time. Well, as you guys can see, that ended up being the high, and pow. Okay, so when you're long in a market, I actually won a trading competition like this in Vegas one year. We had the distribution above, and so I had taken a trend continuation trade. Looking for a resumption, but then we started getting up here to the distribution, And so I said, hey, look, I got to take my profit on this. I got this thing called an inventory retracement bar. We're about to hit that. I got to get out. And I actually won a trading competition like that where my opponent just kept pushing because he was behind and kept pushing, and I locked in my profits at the right time, and the market rolled over. So also the entire band of the IRB wicks are key support or resistance levels until broken and can be used as excellent likely reversal points for a market trend. Okay, so this this is pretty much exactly like that situation in Vegas that I was telling you about 1 year, where it pushed up, locked in a big distribution bar, then it came back down. I went long, and so then I got out as we got back up to the distribution, and then the market never looked back. Same kind of concept, okay? Here now, this is a great example. So notice that what happens is, here's the distribution bar. Can everybody see it? That's the distribution bar, 45% or more off the high. Well, notice what happens then. The market starts going down, it rallies back up, and it rallies right into that distribution. Then it rolls over. Now that creates its own new distribution bar. And so let's just highlight that for you. So now all of a sudden, look what happens. As the market, it rolls back up in here, can't break through that distribution, rolls back up, hits precisely the bottom end of that distribution, and then rolls over again. Then it starts going sideways here, makes another distribution bar here, and then never got through that. Okay, so what happened was new plateaus of selling kept coming in over and over and over again, keeping this thing from having any sort of rally. Very important to understand, all right? So those are those different additional rules that I want you guys to remember here. Very important. Don't forget how we use this. And so now let's circle back to some of the things I showed you earlier. Now you can see why, wow, I had all these inventory retracement bars of the accumulation kind, but I had sell signals on the 2-minute chart on the lower time frame. And I said, no, I'm not taking that trade because of 4 IRBs, all right? Well, sure enough, look what happened. Major trend reversal. You following me? Now, then right over here, now you can see, all right, we had the beautiful trend in place, and we had that accumulation bar. Once we break below the accumulation bar, we're expecting a continuation. And so that went ahead and led to a nice $1,250 profit on the bonds, all right? But now you can see, remember that when you lock in one of these distribution bars, this is a resistance level until broken. So when I saw that lock in, I was long. I got out of the trade, took my profit, and ran. Was that the right decision? Absolutely. Okay. Then we have a nice trend in place to the downside. There's another trade we took in the trading room there. And what you're doing is you're looking for that accumulation bar to be broken below, and then you're expecting a whoosh to the downside, okay? Now, when all of a sudden, when you're short and you start seeing accumulation bars come in, this was an example of where I took a 3-tick stop loss, and this ended up being a great reversal point. You try to keep those stop losses as tight as possible. I've had, in the last several months here, I've had incredibly low stop loss numbers in the live trading room, and my biggest single profit morning in the live trading room was actually just last week. It was like 7,200 plus gross dollars, sorry, 7,200 plus gross dollars in one morning there, and yet my stop losses have been a fraction of that on a gross profit basis. So really great stuff. So here's an example. I took a 3-tick stop loss in this, going ahead and identified, accumulation's coming in. I'm short. I got to get out of this thing because this could be a reversal. And sure enough, it was, right? So different ways we're using it to get in, stay out of different types of trades, right? Then went ahead and same thing. We get that beautiful uptrend in place, break above that distribution bar, and what do we expect it to do? Whoosh to the upside. Is this making sense? Trying to get you to think about the equity curve. I'm trying to get you to think about this in a very logical, format, and understand this. These are the same types of things that I've used in trading competitions, around the world. okay, and combinations thereof. So this is very near and dear to my heart. I talked about here just recently, earlier this summer. Now look at that. So can you see that with your naked eye now? Beautiful downtrend, accumulation, 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 accumulation. Can you guys see it? Does it make sense now? You see why I'd be looking to maybe short this market, focus on shorting to win a trading competition? And I see some great questions coming in. I'll go ahead and I'll answer those in a few moments. Let me go ahead and tell you about something that I want to do for you guys. I've never, ever done this before in a public event. So we're doing something kind of crazy. I'm trying to do something different. I love Dan. I love what he's doing with investing. And so I'm like, okay, I'm going to do something completely different today for people. We have this premium nightly day trading and swing trading videos and alert service, which also comes with some great starter package of indicators of mine, which is really awesome for many different platforms. So if you go to becomeabettertrader.com/champ, becomeabettertrader.com/champ, what I want to do is do something. I've never done this before, but I'm going to offer a $7 trial. I've never done this at a public event like this before. $7, give you guys 30 days access to my premium nightly day trading, swing trading videos, the trading alerts, and access to a whole bunch of videos as well. So I've got about 2,200 videos on day trading and swing trading. I put out the videos, throughout the week, and the hottest markets I'm looking at, the hottest strategies I use in the trading market. So pretty cool. $7. It's like virtually free for 30 days trial to the trading room. And then if you stay on them, which most people do, then it's a fraction of the normal cost. So it's really great. There's so many different things you can learn. I'm not going to read all these different things to you, but it's for stocks, options, futures, and Forex traders on a day trading or swing trading basis. These videos are not really geared towards long-term investors only. It's geared towards more active investors, anywhere up, to several months, if to, couples of minutes or seconds. So it includes trade alerts. In fact, I just put out a great trade alert yesterday there for the afternoon. So giving key levels on key markets that I'm looking at, where I'm looking to go long, short, stuff like that. And so that's really great. So you kind of know what I'm thinking. And so this way, if you're away from your computer, you get the text alert to your phone. We've got a phone app. We've got a trading app. You get the text alert to your app, and then in your email as well. It also includes lots of Q&A sessions, so you guys can come in and ask me questions in an open environment as well about any of the favorite strategies you've been learning through my nightly videos and stuff, and also student trade reviews. For those of you that like to record your trades, I go ahead and actually am more than willing to record those or review those trades publicly in the nightly videos. I'm happy to do that so we can kind of review your trade about what my opinion is, what you did right, wrong, and could do better to make a great learning opportunity. It's almost like me being by your side. So what's really nice is all that plus these trading videos. I mean, $7 for 3 days. If you don't like it, hey, you know what? I'm a real trader. I'm doing the trading around the world. My company is highly successful, and I've done all these incredible things. With my trading here, I'm profitable this year. I know a lot of people aren't profitable this year. They've been getting battered around. I am profitable, and I was profitable last year. I'd love to go ahead and show you what I'm doing and how I'm doing it. And I've got these training videos here, and so if you go to becomeabettertrader.com/champ, you can get access to all these different videos. What that looks like is, and I'm going to answer all those great questions you guys have in just a moment. I just wanted to kind of show this to you real fast, and then we can talk. So if you go to member tools, you're going to get access to things like down here in the lower right-hand corner, the Trade Like a Pro series, and these member Q&A sessions and that. So some really cool stuff, these nightly day trading and swing trading videos. And let's just click into it since we're in this environment here today. I could have had 50 titles for this great strategy video last night, and that's what I call it. I could have 50 titles. But look at this. Rob breaks down a trade in fine detail for everybody to learn from. Usually I take stuff from the day trading room, as you guys can imagine. The video every real trader needs to see. All sorts of different videos that we consistently are putting out. All these different videos on day trading. Most of it's taken from the room and what you need to learn and understand, and so on and so forth. And then on the swing trading side, we've got all these videos that I put out there. As you know, like here I did 8 different stocks I reviewed last night. You know, got all sorts of different, you can see some of the different titles, the different stocks I review each evening, and so on and so forth. So that's really really nice. And you know, what happens is you get access to the section called Access to Rob, and this allows you then to come in and post questions to me so that I can you know, review your favorite you know, trading ideas and such. So you know, it's really nice. Like here, you go access to Rob, you can say, hey, potential longs, you know, ones you're looking at, different instruments, and then I'll go ahead and in the nightly videos, make those part of the nightly video. So it's like having me by your side. Hey, Rob, what do you think of these from your perspective? And I let you know what I think of them. And so that's pretty cool. So, and then, like I said, just a huge, vast expanse of different trading videos. You know, I love the section that we've created here, like the Trade Like a Pro series. We've got so many different videos in there on different topics, how to use different strategies of mine, and so a lot of really great stuff that you guys can learn from along the way there as well. So all that for like $7. If you don't stay with me, that's okay. Then basically you paid effectively nothing to go ahead and get access to great information. And then if you stay with me, you get to stay for a fraction of the normal monthly price. So it's a win-win no matter what. Okay, so that's what I wanted to share with you there. We can put the link in there for you. It should work just fine, or you can call the office as well and get help there. But let me go ahead and start answering these questions for you, and I'll put the link in there because I know that's one of the questions I always get. What's the link again? Especially if we go off screen and start looking at live charts together. So I'm just going to type this in for you right now, gang, and start answering those questions. All right, and let me just hit save so I don't have to keep typing it over and over again. There we go. All right, let's see what your questions are here, how I can answer them. Is it easier to find more trading opportunities with this entry on smaller time frames like the 5-minute bars versus, say, weekly bars? Well, okay. The short answer is yes, because what happens is on a weekly chart, you're going to be in a situation where as you can imagine, in fact, let me just go ahead and actually get some charts up here. It may take me a second, but and all right, well, I'm trying to get you some charts up here, gang. They got hidden back behind, and so let's. So as far as, I'm not sure what you like to trade, but yeah, as far as the weekly charts, as you can imagine, the higher the time frame you go, the less instances you're going to have. So you're going to wait longer periods of time. So like here, let's just take Tesla for a moment. Okay, so Tesla, we're pushing up here. It has the inventory retracement bar, the distribution kind. Well, now you're sitting there waiting 1 week, 2 weeks, 3 weeks, 4 weeks, 5 weeks, 6 weeks. Oh, week 7, it broke above there. Okay, so it took 7 weeks to go from signal bar to action bar. Does that make sense? Whereas now you go look at a 5-minute bar, you know, here with the, let's say like the NASDAQ, we had a signal on that this morning. In fact, I had shared that with you guys a little bit earlier. And so take a look here with the NASDAQ. All right. You might have multiple signal bars in a short amount of time. So here's a distribution bar at 10 o'clock in the morning. Well, then at 10:45 or so in the morning, you had another one. All right. And both of those, as you can see, resulted in whooshes, but they were effectively 45 minutes apart from each other. Does that make sense? So clearly, you're going to have way more signals on a 2-minute or a 5-minute chart. You could easily have, I actually did some research on this one time. It was, I'll let you sort of hold me to this. It was approximately 20 or 25 signals in a 24-hour bar off of a 2-minute chart, I believe is kind of how it more or less worked out to, versus obviously a weekly chart. We saw if you're just looking at Tesla, you'd have to really scan a lot of different instruments, because what's going to happen is you got to have your signal bar, and then you have to have your entry bar, which, as we saw just like with that Tesla example, could take 7 weeks till the next one. But you're talking about big plays that are, you know, big swing trades. You're not talking about a 5-minute trade, right? So it's based on what you're hunting there. Does that make sense, Niraj? Okay, and so as far as so I have a lot of people, Chuck, that use this on an options basis, because really what you could do from my perspective is you could take this now and use this on a daily chart basis, or even a weekly chart basis, because if you understand, let's just take the NASDAQ here for a moment, all right, and if you all of a sudden, let's say you're bullish and you've got a bullish options play on. Well, now you have your beautiful uptrend in place. You have your distribution bar. If we break out to the upside here, the expectation is that there's an opportunity that this is going to continue to work, rather than and whoosh to the upside, rather than just sit there and be like iron condor land, right, where you're expecting nothing to happen. We know that if we break above here, we're expecting a whoosh and kind of expecting a follow through. So if you're bullish and betting bullish on the market, then you're feeling real good about yourself. If you're in an iron condor, then you realize, uh-oh, that's not a good place to be. And if you're not an options play, you can go out there to the next monthly, and say, hey, this is really good. So what I'm going to do is I'm going to put on a weekly or a monthly position, based on your analysis and what you see there. So from my perspective, it has just as much of a options focus as anything else. Does that make sense, Chuck? So let's take a look here. NASDAQ 8-hour chart. I see your strategy. Could you make a comment? Okay, I don't have an 8-hour chart here, but you're welcome. But as far as hourly in general, as far as that strategy is concerned, there's no reason why you can't use the strategy. The key thing to keep in mind with an hourly chart, all right, so let's just, right now I'm looking at a 1-hour chart here of this. Let me ask you a question. Is there any high probability trade from your perspective based on what's happening with the trending? What are we looking at for trending here, gang? What we're looking at is we're looking at the last 20 bars of data with the 20-period exponential moving average. So in your case, you'd be looking at about 160 hours worth of data if you're looking at 28-hour bars. All right, and then you're going to want to see, if you have a trend before you're looking to do any sort of entry. So keep that in mind. You're going to want to you're basically looking at 160 hours, 28-hour bars. So as far as that's concerned, though, I don't have an 8-hour chart up here, but what you're going to be looking for then is a bar that's 45% or more off the high, and then you're going to be looking to break above that in an uptrend, okay? And right now, for the most part, should be able to get an uptrend out of a 28-hour bars, just based on what we're seeing here. So then you'd be looking for that distribution bar to break above. And by the way, if you guys have been following along with my trade alerts, you know that I've been very bullish above. If you guys were in my live trading room event that I did this morning, you know that I actually went ahead and was focusing on long side trades above 6,000. So it kind of all ticks and ties. All right, and let's go ahead and take a look at Robert. Let's see, how do you look to establish initial profit target that you use on the trailing stop? Okay, so what we talked about there earlier, Robert, is I like to really use these pivot points, the daily, weekly, monthly pivot points, and the 50-day and the 200-day moving averages, okay? So very common, well thought out, well used over many years. The pivot points, we're talking about classic pivot formula, classic pivot formula here. All right, not this stuff that's been made up by people that are slapping their names on it. Classic pivot formula, and most of you will have that in your platforms as either floor trader pivots or whatnot. So that's how we're basically looking to identify opportunities. I will put the link back in there for you guys there. It's becomeabettertrader.com/champ. Absolutely. So, I look forward to having you guys as part of our student family. Let's see, I think you're very welcome, Robert. Happy to help. All right. So what I want to do in my closing moments, I want to go ahead and thank our friend Dan for going and hosting a phenomenal event today. So thanks, Winvesting. And I want to thank all of you guys for being really active, paying attention to this, because, gang, I put some heartfelt thought into this. This is stuff that I use in my live trading. I use it in trading competitions. I showed you some real-life examples of ways that we use it and some circumstances that we use it. So this isn't theory, summing up that big picture all the way around. This isn't theory. This is, practical, real-world trading knowledge and experience that I'm talking to you guys about with today. So I basically gave you effectively 30 days free access to these nightly day trading and swing trading videos and that, so you guys could see that, wow, this guy's full of real world knowledge. I want to stay with him for the long term. Okay, so thank you as well. That's really nice. I appreciate you going ahead and sharing all those nice comments. Dan, I'm going to turn it back over to you. Thank you very much for having me here with you and this great student family today.